After nearly a year and a half of massive outperformance, the exuberance in the broader markets appears to be fading. Since July 1st, the BSE MidCap and SmallCap indices have gained 2% and 2.5% respectively, as against over 7% surge in the BSE Sensex index. Individually, stocks such as Sadbhav Engineering and Ujjivan Small Finance Bank have tumbled up to 45%, AC equity data show. So, is the multi-bagger phase of mid and small caps over? Not really. While analysts believe profit booking in the broader markets was long overdue, they see this correction as an opportunity to pick quality stocks. We caught up with Ashish Chaturmohta, Director Research at Sanctum Wealth, to understand if the correction will last longer. This is what he has to say.
Yes, the BSE circular slowed down the momentum, but a correction was due as the rally was very sharp and quick. The profit booking won't continue for a long and we would see quick recovery. However, the recovery in quality stocks would be much quicker. Mid-caps and small caps are volatile, but at the same time they are wealth generators. Example, Bajaj Finance was a mid-cap and today one of the blue chips. According to me, all quality names should be buy on dips candidate, as one doesn't know the bottom, but at the time of recovery, these stocks will attract the highest inflows.
On a year-to-date basis, the S&P BSE Small Cap Indices has rallied over 40%, while the BSE Mid-Cap Index is up 26%. In comparison, the benchmarks are up around 18% so far in 2021. The NSE Nifty 200 Index, meanwhile, has more than doubled from a March 2020 low. However, thanks to a massive liquidity boost from the central bank and foreign inflows, the broad-based rally has pushed the valuations to expensive zone. According to Jitendra Gohil, Head of India Equity Research at Credit Suisse Wealth Management, the near-term indicators for equities are looking stretched. The MSCI India trades at a 12-month forward PE premium of 83% versus the MSCI Emerging Markets Index. Historically, the 10-year average premium has been around 42%. Given this, he says investors should cut exposure to mid, small caps, high allocation to large caps. Meanwhile, Amish Shah, India equity strategist at BofA Securities, believes the gap between Nifty premiums relative to mid and small caps has narrowed after the massive rally since March 2020. From a near-term perspective, he prefers large caps. On the flip side though, a section of analysts believe the 12-month trailing basis valuation is bound to look expensive due to a sharp run-up in stock prices, combined with low earnings last year due to the COVID-19 pandemic. Let's go to Gaurav Dua, SVP Head of Capital Market Strategy at Sher Khan by BNP Paribas to know more.
If you look at the trailing 12 months price to earning, it will not look cheap at all. Same way is with Nifty also, because in last about a year, the corporate earnings were impacted because of the lockdowns. However, if you take into account that the global economy for next few years is going to do pretty well, Indian economy is also likely to bounce back. These projections are of 9.5% growth in this year and 8.5% this next year. With this kind of upcycle and strong growth in earnings, we believe that on a forward basis, valuations are not cheap, but they are also not too expensive. And this thing, as I said, overall, you have to be now very careful, selective. You have to stay away from the speculative momentum stocks. However, if you do your study well, pick up the right stocks, there is still a lot of opportunity to make money in small and mid-cap space.
So, taking valuation concerns into account, how should one start stock picking in the space? Aishwarya Dadich, fund manager at Ambit Asset Management, decodes this for us.
It is also important to identify that that investors should now invest into quality businesses. Easy money making is behind us now. Investment into speculative names, investment into weaker franchise should not be done. What investors should focus upon from here onwards is to assess whether the businesses that they're investing into exhibit these three important traits. First of all, these businesses should show higher earning growth trajectory. It's all about earnings. Second is that these businesses should be on the beneficiary side of formalization induced by the COVID-led economic impact. And third but not the least, that they should have a very strong balance sheet so that they can scale up their business big time over the next 3 to 4 years.
Let's now look at the stocks and sectors that fit the bill.
So basically, we believe that there are two extremely strong themes which are going to be there for next few years, and where there is a lot of opportunity. One is export upside. What we are seeing is that a lot of these smaller sized players also, who have a large exposure to exports, they are doing extremely well. They could be in the auto ancillary space, they could be in the textile space, textile space, garment space, building materials, specialty chemicals. So we see opportunity there, because that is the part of the business which is on a structural upcycle. Another is the basically economic revival in India. So you need to also play that, because what we are seeing is vaccination is now going strong. 60 crore people have been vaccinated. You might have the third wave, but what we have seen is that the economic impact of wave 2 was lower than wave 1, and we believe that the economic impact of wave 3 will again be lower than this thing, wave 2. So based on this fact and the fact that the interest rates are low, corporate earnings will be strong, we believe that one also needs to look at space which are going to do well because of the revival in the economy in India. So here we have the select stocks in the consumer space that we like. We also like some stocks basically which are corporate lenders. We like some stocks in this building material space, basically steel, cement, tiles, pipes.
Look out for sectors which possibly are a play on the revival on economy. Possibly a content intensive sector can play out. Just to give some example, a luggage industry could see really strong traction building up over the way when things will open up in the next couple of years. Consumer discretionary could be the another sector which can really play out well in coming years. We are also viewed that chemical as a space will continue to do really well in the next 3 to 4 years. And so is IT. The pace of digitization in the deal pipeline is clearly indicating the way the traction will build up over the next many years. We are also very positive on mid-cap, mid-sized BFSI names, NBFCs names, which we believe as and when things improves post the COVID situation normalize, this will see massive traction in credit growth as well as the normalization of asset quality happens.
Among individual stocks, analysts from Edelweiss Securities remain bullish on Jindal Stainless, JK Cement, IEX, CSC, Federal Bank, Suntec Realty, JSPL, Gujarat Gas, Quess, Birlasoft, Concor, VIP and FirstSource. Now, analyst Ashish Chaturmohta of Sanctum Wealth remains bullish on Stovecraft, Linde India, Sona Comstar, Tata Elxsi, LTTS and L&T Infotech.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com.